Good morning, everybody. Good morning. We'll start very shortly. Thank you for logging in. The numbers are just coming through at the moment. I can see more and more attendees are just dropping through. We'll just give it a minute or two whilst we wait for people to sign in. The numbers are already flying, so that's great. Just for anybody that, as you're logging in, if you're logged in through a cloud environment like Citrix, we tend to find this works better outside of a cloud environment. Just sort of cut and paste the web address into a browser outside an environment. But my guess is if you got this far, then you've probably got no problems anyway. But we just recommend that. And if there are any technical problems throughout the course of the presentation, Lizzie in our team will just drop in, and so if you hear any commentary from Lizzie, that's just our technical person just helping us out. So we'll just give it 30 more seconds and then we'll get going. See more people just dropping through. That's great. Okay. I think we're there. Right, let's make a start. Good afternoon now, everybody, and welcome to this webinar, the third in the series, titled "What's It Like to Sell a Business?" So this is a trilogy, the final part of the trilogy. You may recall, some of you will have attended our first presentation 2 weeks ago on part one, being on sort of planning for a sale of a business in 2020 and beyond. That was followed up by a presentation last week by Jack Minns, talking through the process of selling your business. And today's event is, we're trying to bring it to life a little bit more. We're going to talk a bit about the tax situation for sellers, but I'm delighted to say we've got a guest in today who sold their business in 2020. And what we'll do is we'll go through a question session with our guest and give you the opportunity to ask any questions that we might not cover. So all of those presentations are available on our website. Today's will be recorded and put on there as well. So if you'd like to go back over those, or if you know anybody that would be interested in the content, then please refer to our website. They'll all be there. In terms of hosts today, my name is James Lay. I'm the partner in charge of our corporate finance department at MHA Larking Gowen. I've been with the firm for many years, over 20 years. I've been doing corporate finance since 2004. I'm joined today by Jack Minns, who, as I say, was presenting on the previous webinar. Jack will come in to the presentation a little bit later on. Jack is a director within our team. Corporate finance, we've covered it on the previous webinars, but corporate finance for us is very much buying, selling, and valuing SME businesses. That's what we focus in on: buying, selling, and valuing. And our deal sizes are typically somewhere between, say, £2 to £5 million, but sometimes they're smaller and sometimes they're larger. So that's the kind of sectors that we're working in. In terms of the agenda today, we're first of all going to cover off, as I say, the tax aspects of selling a business. And I'm delighted that Richard Proctor, our corporate tax partner, will be presenting the slides on that. And then the second part of the presentation today, we're joined by our guest. It's David Holland of Salix River and Wetland Services Limited. David will be giving some context to the deal so you can understand the background to that. We'll talk you through the process. We'll bring it back to the process that Jack talked you through in the previous webinar, so you can see that brought to life. And then we'll be doing some Q&A with David. And as I mentioned before, there is an opportunity for you to raise questions. There's a question box you'll find available to you. If there's anything in there that you'd like to ask either Richard on the tax side of things or David on the sort of experience of selling side of things, then please pop your questions in there and we'll cover those off at the end. So I think that's the background there. I'll hand you over to Richard, who'll talk you through the tax side of things. Richard.
Thank you, James. Good afternoon, everyone. Can everyone hear me? Strange question, as most of you are muted, but I'll assume that you can. Yes, as James said, my name is Richard Proctor. I head up our tax advisory group. I work closely with James, Jack and the team on transaction tax. Tax is often an important feature of any transaction. So looking at the first slide that Jack's put up for us there, this is looking at capital gains tax. We will talk about other taxes, but capital gains tax is probably the main one that we should focus on in any transaction, at least initially. So if we're looking at a situation where we're selling shares in a private company, or indeed maybe a member's voluntary liquidation of a company after a sale of assets, and we'll look at the comparison between sale of shares and sale of assets in a moment, then we're looking at capital gains tax for shareholders. So you're selling shares, you're receiving money for your shares. You may have subscribed a very small amount for those shares at the beginning if you were the founders of the business, and therefore you're looking at a sizable capital gain. And as most of you will appreciate, the key relief that we often focus on is what used to be called entrepreneurs relief until this April, and is now called business asset disposal relief. And that relief gives a 10% effective capital gains tax rate, which is the lowest rate that we can achieve, unless there's other exemptions around, like enterprise investment scheme, for example. What are the main conditions to secure the relief? Well, you have to have a trading company or shares in the holding company of a trading group. Following the Finance Act 2019, you have to have owned the shares for at least 24 months. It used to be 12 months, but it's now 24 months. You have to own at least 5% of the company's issued share capital, and you must have 5% of the voting rights and 5% of the rights on a winding up. And finally, you need to be an employee or director. You don't need to be full-time. There isn't a minimum hour requirement, and there isn't a minimum salary requirement, but it needs to be a real employment, and director normally qualifies for that, of course, but it is important when you're looking at all shareholders that they have a genuine employment if they wish to claim this relief. The lifetime limit sadly came down from 10 million to 1 million from April this year. That was the change, along with the change of name that was announced in the budget on the 11th of March. So we are now looking at a much reduced saving from business asset disposal relief. But nonetheless, the main rate, as we've got there, is 20% at the moment on shares, and therefore it does halve the rate for the first million and does save £100,000 in tax. So it's certainly worth securing if we can do that. So getting capital treatment is obviously an important factor in any transaction, because it then gets us into capital gains tax rates, which, as we've just seen, can be 20% or 10%. The last thing we want, frankly, is for proceeds, normally anyway, the last thing we want is for proceeds to be taxed as income, because the marginal rate of income tax is currently 38.1%. So that's obviously much, much higher than the capital gains tax rates. So where are the risks of an income tax charge arising on a share disposal, for example? Well, the first thing to think about is employment-related securities, as we've got on the slide. If you've acquired shares and you're an employee, you were an employee, or you become an employee after the share acquisition, then they are deemed to be employment-related, those shares. And that does bring in a raft of anti-avoidance rules, which can apply where the shares are sold at more than market value, or where the shares are restricted and restrictions have been lifted before a sale. So if there's any kind of manipulation of the value of those shares so that they gain value more than the commercial growth, if you like, justified by the good work that Jack and James do, then you're in danger of suffering an income tax charge on the disposal on at least part of the proceeds through these rules. There is an election that you can make when you first acquire shares. It's called a Section 431 election, and that gets you out of these rules. It means that you might have an income tax charge at the beginning based on the market value of the shares when you acquire them, if you pay less than market value. But it does then mean that any future proceeds from a sale are only going to be subject to capital gains tax and not income tax. So one of the planning points, if you're starting a company, is to consider whether that election should be made, because that will give you some certainty going forward, certainly under current rules. Another area that we always look at with transactions, but typically where there's a mixture of consideration, such as loan notes or shares in the acquiring company, are the transactions and securities rules. So this is where the revenue can recategorize capital receipts as income, where they believe there's been a transaction in securities which is principally there to avoid tax or avoid income tax. Fortunately, we can go to the revenue in advance of any transaction, and we can set out the features of the transaction, the commercial rationale for why we're doing it in a certain way, the justification for the mix of consideration that's been chosen. And if the revenue are comfortable that the transaction is commercial, that one of the main purposes is not the avoidance of tax, then they should give us clearance that they won't apply these anti-avoidance rules in this situation. So we would certainly recommend seeking advance clearance where we can. It does perhaps add a bit of a delay to the transaction. HMRC is certainly taking the maximum 30 days that they have to respond to clearance applications at the moment. So that needs to be planned in any transaction step plan so that we don't mess up the timing from a commercial point of view by waiting for a tax clearance when we really want to complete the transaction. The other area of anti-avoidance I'll mention is that on liquidations, on members' voluntary liquidations, so if a company has sold its assets and therefore has cash in the business which we then want to extract, a tax efficient way of doing that is usually to appoint a liquidator, put the company into liquidation, and the liquidator distributes the cash to shareholders, back to disposal of shares for tax purposes, and gets us back into the capital regime rather than paying out dividends, which would be subject to income tax. So the risk there is that if there's an anti-phoenixing motive, if the revenue believe that you're going to carry on your business in another form, then they might recategorize that capital distribution from the liquidator as income, and that would be subject to a dividend at the highest marginal rate of 38.1%. So again, we need to look to make sure that what you're doing after the sale of the shares or the liquidation of the company wouldn't bring in those anti-phoenixing rules. Just looking at other planning, clearly early on in the scoping of any transaction, one would consider whether it should be a share disposal, as I've mentioned, or an asset disposal by the company. And we'll look a bit in a bit more detail at that very shortly. As I also mentioned, we look at the structure of the consideration. So these are usually commercial imperatives. Does the purchaser have the cash? Is it a management buyout, which means that there perhaps needs to be loan notes or deferred consideration? So in that situation, we do need to consider the tax implications. Do we suffer a capital gain on the full value of the consideration, even though some of it won't be received until 2, 3, 4, 5 years down the line? Or do we prefer to defer any liability, which may increase the risk of future tax increases, but means we're not incurring what's known as a dry tax charge, i.e. paying tax on proceeds that we haven't yet received. Inheritance tax, as we got there, is a big issue, probably post-transaction, in terms of you may currently own shares in a private company, trading company, which qualify for business property relief and therefore wouldn't count in your estate for inheritance tax purposes. But as soon as you sign the contract to sell the shares, you've then got cash or cash equivalent, and that will be fully taxable to inheritance tax, currently at 40%. So there is a big change to a shareholder's inheritance tax profile when they sell shares, and clearly there's some planning that we could do around that, which we'll touch on briefly at the end. And finally, other planning, we could consider dividend extraction. And you might say, well, why do that? You've said that you want capital disposal in most cases, and that is true. But there may be instances where a dividend is the right move. For example, if we've got too much cash on the balance sheet, or we've got assets on the balance sheet which mean that we're not a trading company for the business asset disposal relief, then we might want to consider extracting that cash or that asset from the company as a dividend prior to a share sale, so that we do secure the relief on the eventual sale of the shares. So just coming back to the share purchase, asset purchase analysis, I won't dwell on this too much, but just to give you some flavour of the factors to consider. So if we look at the table in front of you, a share purchase, clearly the entire assets and liabilities of the company are sold in one go as a neat package, if you like, from a commercial perspective. But equally, all of the liabilities and history go as well, as we'll see with due diligence in a minute. Whereas an asset purchase, you're effectively cherry picking as a buyer the assets that you want, and perhaps liabilities as well, but again, you can pick and choose. Warranties and indemnities, if you're buying a company, as I say, you're buying a company with all its history, all its potential liabilities, real or contingent, and therefore you would expect the seller to give extensive warranties, as we said there. That wouldn't be normally the case with assets. Disclosure, there would be a detailed disclosure process with a share sale because of the risks involved, but again, that would be greatly reduced with an asset transaction. And equally, due diligence, the buyer would usually make some extensive inquiries into the financial health of a target business if they're buying shares, whereas if they're buying assets, then the risk is much lower. Trading position with a company, the existing contracts with suppliers and customers would carry on. You know, the company hasn't changed in any way, it's merely the ownership at shareholder level that's changed. Whereas if you're buying assets, then that clearly isn't the case. And if you're buying goodwill, for example, then you will want to take measures to ensure that you're able to retain that goodwill and that you are able to secure, for example, the contracts with customers going forward. Method of transfer, it's correct to say that a simple stock transfer form will transfer the ownership of shares, although I have to say that in any private company transaction, there's normally a fairly substantial sale and purchase agreement that goes with it, usually in excess of 100 pages. With an asset sale, it'll depend on the asset, the nature of the asset. Clearly, if it's property, there would be a conveyance and a legal contract. In other cases, it would simply be a commercial agreement or contract. So that will depend on the asset that is being sold and purchased. And continuing with the theme, with a share purchase, stamp duty applies at 0.5% at the moment. Whereas if it's an asset purchase, there's no stamp duty on goodwill, but a property would attract stamp duty land tax, and that can vary from 0% to 5% currently for non-residential land and property. As we've seen, if you sell the shares, you're likely to be paying capital gains tax at 10 or 20% currently. If you're selling assets from a company, then there's the risk of the double charge, i.e. the company will pay corporation tax on any gains realised on the sale of assets, and then we've got to get that money out of the company. And I mentioned a liquidation as one route, but if we can't do that for whatever reason, we might be looking at a dividend, which then gives rise to a fairly high effective overall tax rate, i.e. a combination of corporation tax and income tax on dividends. With a share transaction, the losses any trading losses that the company is carrying forward would remain with the company and would be available going forward as long as there's no major change in the nature or conduct of the trade being carried on. Whereas a transfer of assets, the losses would normally stay with the company, and if the company is liquidated, those losses will go. Capital allowances, with a company, there's no change, it carries on. With assets, then you're acquiring any assets that you acquire, plant machinery that you acquire, which qualify for capital allowances, then you're effectively rebasing the capital allowance value at the acquisition cost. There's no VAT chargeable on shares, but there might well be VAT chargeable on a suite of assets that you purchase, again, depending on their nature. Although if you are able to get within the transfer of a going concern provisions, so you're buying a business and you can demonstrate that you're going to carry on that business on an independent basis, then you can get exemption from VAT if we can be satisfied that it is a transfer of a going concern. And finally, just to consider one or two other tax planning matters which we've touched on before. So inheritance tax, as I've said, shares in unquoted trading companies normally qualify for business property relief, whereas cash equivalent, loan notes in a purchasing company wouldn't qualify, and therefore you will need to consider other planning if you're concerned about your inheritance tax position post-sale. That could mean reinvesting in new assets that qualify for BPR. There are funds out there, for example, that would invest in AIM-listed shares. I'm not suggesting that's a good investment strategy, but it is an option for inheritance tax planning, or gifts, or use of trusts or family investment companies to allow you to transfer wealth perhaps down to the next generation. You can insure against the liability, which clearly would depend on your age and health, and you can do a certain amount with wills to make sure that you maximize nil rate bands and allowances. And finally, as I've said there and mentioned before, we shouldn't dismiss dividends versus capital extraction when we're looking at a run up to a sale. There might be good reasons why extraction by way of dividend will give us the best optimum overall tax position. Right, I'd like to hand over now to Jack, I think, who's going to introduce our guest speaker.
Thank you very much, Richard, and good afternoon, everyone. For those that perhaps don't know me or didn't see the presentation I did last week, my name's Jack Minns, and I'm a director in the corporate finance team at MHA Larking Gowen. As James already alluded to, I'm delighted to say we'll be joined by David Holland today, who's founder of Salix River and Wetland Services, and we'll be having a Q&A with David shortly to see just what it's like to sell a business from the viewpoint of a seller. So if you do have any questions for David, or indeed any tax questions for Richard, then please do submit these in the question box on your webinar toolbar, and we'll come to go through these at the end. They do only come through to the presenters, so these aren't shared with other participants. They can be asked in complete confidence. But before I dive into the sort of Q&A with David, I just thought it'd be useful to set the scene a little bit for our audience and provide some background on Salix and the deal itself. Just to be clear, we won't be talking about deal values and the like, as obviously that's confidential. But I can say it's a good size transaction and right within our firm's sweet spot in terms of sort of deal sizes we generally deal with. So Salix River and Wetland Services was founded in 2003 by our guest today, David Holland. Started out initially primarily providing ecological consultancy services, and following a period of sustained growth and investment received from the Rater family in Norfolk, Salix developed into a full sort of turnkey products and services provider to solve challenges found in soil and riverbank projects. So they specialise in spillway and shoreline protection, inland dredging, habitat creation schemes, all done with sort of ecological and green motives at heart. So it's offering sustainable and green engineering solutions to perhaps quite hard civil engineering services that were used in the past. And as part of Salix's development, the nursery where it grows its wetland products and wildlife species, they've actually got the largest nursery of these specific types of plants within the whole of the UK, and we think potentially in Europe. So this was a huge sort of USP for Salix, because they weren't dependent on other producers for the vast majority of their products. They actually grew a lot of them in-house. So it helped reduce carbon footprint because a lot of the products were sourced in the UK, and it also meant that Salix was very competitive when it's bidding for projects against some of those harder civil engineering alternatives. Post sort of the Rater family coming on board, there's also a contracts director brought in called Pete Barlow, who also became a shareholder in the business as the company continued to grow. And Salix really became a one-stop shop for designing projects, supplying the product, and then actually undertaking the projects themselves through the contract. So, you know, Salix could play a role throughout, whether it's helping clients in terms of offering different solutions that they could undertake, providing the actual products, or actually managing the contract as a whole. And so this was a key part of the growth of Salix over time. And as I say, in essence, you know, Salix's key USP was offering low carbon, sustainable engineering solutions in place of hard engineering techniques, and that was really what was at the foundation of the business. In terms of their sales process, for those that you joined last week, hopefully this slide should look very familiar in terms of our 11-step sales process that we typically follow. And I'm going to just walk you through the journey we went through with Salix, just to bring this to life a little bit in terms of timings and things that happen at each step. So we first met the shareholders of Salix back in March 2018 in London at our MHA McIntyre Hudson office in Blackfriars. This was a good central meeting location for everyone. David is from Wales, Pete was from the Midlands, and then Edward from Rater Farms from Norfolk. So it was a good central meeting point for everyone, and it was a base we could use for meetings with potential buyers in the future. And as part of that initial pitch meeting and talking to the shareholders, we talked about the value of Salix as we saw it then, but also its potential for the future. And the company's year end was October, and the business was in the middle of a very good financial year. And so we talked in partnership with the shareholders about what their desired exit timelines were and priorities. You know, we were comfortable to sell the business now, but actually, if the shareholders wanted maximum value, you know, our suggestion was, well, you're having a great year right now. Why don't you go and conclude this current financial year so that when you go to market, you can demonstrate a high level of earnings to potential buyers. And obviously, if the shareholders were keen to get out right away, then that's the path we'd have gone down. But we could see clear ways in which value could be increased. There are lots of growth opportunities for Salix, and if we could document to potential buyers that actually the past is irrelevant in some respects, it's all about what it's going to do going forwards, we were sure it could add, you know, quite a lot of value to the price compared to what it might have been had we hit the market there and then. So following the initial meeting, we were instructed to work on the assignment, which was great news, and we began preparing the business for sale. So we did advise the Salix team on some strategies for increasing profits in the lead up to their year end to help maximise that value and how they could present the accounts in the best possible light. And at the same time as working on the financials, we also introduced a team to a local corporate lawyer to go through a pre-sale legal sort of health check. And this process was useful in terms of identifying certain areas where control processes could be improved, or perhaps certain contracts need to be put in place that weren't in place. And those amendments to be made at an early stage prior to going to market. And I think the investment in both the financial and legal sort of pre-sale due diligence process really paid dividends at the later end of the process, both in terms of the valuation the company achieved, but also smoothing out that due diligence process at the back end. So once year-end accounts had been prepared, we met again in sort of early spring 2019 to go through our first draft sales documentation and buyers list, so we could get these key documents signed off. For Salix, it was really important to get the teaser document I mentioned last week worded in the right way, because as you can appreciate probably from my rather blundering introduction, Salix is quite a niche business, and so it was important to strike the right balance in terms of giving enough detail about what it is the company does without giving so much that a potential buyer could work out who it was straight away. So if we were too vague, then we'd lose buyers at the first hurdle. But if we were too specific, then perhaps we'd lose that cover of confidentiality. So we worked really hard with the guys at Salix around the teaser document to make sure we struck the right balance in that regard. In terms of the potential buyers, we had just over 60 potential buyers that we profiled and approached directly. And on top of that, we received numerous third-party approaches from some of those indirect sources that I mentioned last week. There were companies that we had on our initial list that the guys at Salix didn't want to be included in the process, and they were blacklisted, and we made sure they weren't included. In this particular case, the eventual purchaser was someone we'd identified on our direct acquirers list. It was a company called RSK, and we felt strongly that RSK were a prime potential buyer for Salix. They operated in sort of complementary niche civil engineering. They had a really good company culture and ethos, and actually they've been extremely acquisitive and still are today. They've made multiple acquisitions over the last 3 or 4 years and are well funded for future growth. So they stood out as a great potential buyer from the outset, and actually when we started making our direct approaches throughout sort of mainly throughout June, it's fair to say that it took numerous contacts from us with RSK to get them to sign the NDA and receive the IM. So I think between me and my colleague Matt, we spoke with their M&A director Tony Meakin probably 4 or 5 times before they signed the NDA and received the IM. So we report back to our clients fully on potential buyers' responses as to why they're in and why they're out, but we take great pride and accountability in making sure we've pushed it absolutely as hard as possible, because we come back again to what I mentioned last week. If you don't pick up the phone to the right potential buyer or get the sales documentation through to the right person, you could be missing out on the best deal. So this was a prime example of where persistence really paid off. As I say, it probably took a good 4 or 5 phone calls with Tony before we convinced him that this is a great fit for RSK. You really need to see the information memorandum, and didn't it pay off in the end, because they clearly were the prime potential buyer for Salix. Once we'd done that sort of initial approach work, we held a series of meetings throughout July and August, and it was clear to us in those meetings that buyers wanted an extended sightline of the future business potential. We had included an outturn for the 2019 financial year within the sales documentation, but there were significant growth opportunities for Salix which were included within the sales documentation. So there are quite a few new products that were coming to market. They've just been put on new framework agreements which were going to give them access to new potential contracts. There was actually increased spending requirements under government legislation, where water companies were being forced to spend more of their money on capital improvement projects to rivers and waterways, which played right into Salix's hands. So as part of that process, again, we helped prepare 3-year forecasts with robust assumptions that we shared with all the parties we met with. And this helped move, if you like, buyers' view on maintainable earnings from perhaps looking at the past, and when we'd first met with the client, we had a view on what we felt the company was worth in the marketplace, to actually moving buyers forward along the journey to see actually It's not about the past anymore. This business has got lots of opportunities going forward. It's already operating at a higher run rate than it was last year and the year before that. And actually, it's only going one way. It's only going to keep increasing going into the future. And I think that this was a really important process to go through, as I think without it, we wouldn't have achieved the value that we ended up being offered and completing on. So following the various meetings, there was a deadline set for indicative offers. There were 2 preferred bids that were seriously considered, one from a private equity firm and one from RSK, who I mentioned were the eventual acquirers of the business. Now, our client's preferred cultural fit was with RSK, and it was quite clear that was always who the shareholders were keen to do a deal with. But having other offers on the table helped us leverage and increase RSK's initial offer. So they actually increased their initial offer by just over 12% in terms of what they were prepared to offer on day one. And we also negotiated on top of that a quite favourable and tasty potential earnout to factor in the growth potential that Salix had. So whilst we're not talking about deal values today, the offer price that was paid on day one was sort of double what we thought it was in terms of indicative value 18 months earlier when we first met in March. So, a little bit of work in terms of preparing the business for sale, banking that extra year's profits, preparing some detailed forecasts, and the effect of having competitive tension. So actually having other offers to help bump up the RSK offer, we doubled the value in 18 months. So it does show the importance of going through that maximising value stage and quantifying future growth opportunities if you want to get that top price. We ended up signing heads of terms with RSK in early December, and this was despite the fact that actually the numbers for the year ended 2019 were actually short on initial anticipation. A couple of contracts have been delayed, but again, having that competitive tension, we were able to face up to RSK at an early stage the shortfall, quantify the reasons why, and how it's still about the future, maintain earnings. We're still going to be doing far greater levels of profit going forwards. That just because we came up a little bit short in the current year doesn't mean that the price should be impacted. And thankfully, we managed to avoid any potential renegotiation around price or deal structure. The legal contracts and due diligence stage was very thorough, as you would expect. But thankfully, having been through the pre-sale process, it was much smoother than it perhaps would have been. We were able to provide lots of assistance on with handling the financial due diligence inquiries. Salix were on a cloud-based software, so we could access a lot of the data for them and help collate responses. And likewise, going through that pre-sale due diligence process with the lawyers meant that much of the information that was being requested by the buyer was already in place and presented in the appropriate format. So the due diligence process itself and preparation of legal contracts, it lasted around about 2 months. And then we completed the deal on the 4th of February. Had a nice big completion meeting down in London and got all together, which was really nice. But from the actual point of going to market from sort of late spring, May time through to completion, that process took around 9 to 10 months, and that's fairly typical in terms of what we might see on a transaction once a decision has been made to go to market. And as part of the deal, David, who we'll speak to shortly, is still working within Salix as part of his ongoing consultancy agreement and earnout, as is Pete, one of the contracts director. But one of the shareholders has managed to step away from getting involved with the day-to-day business. They were involved more on the financial side. So that's the sort of process we followed. Lots of value add from the front end, and doing those forecasts really helped, I think. So here's the just to summarise those deal highlights for everyone's benefit. They were in the process of a record year when we met the shareholders, and we encouraged them to bank this before going to market to help boost those maintainable earnings that were being presented to a potential buyer. We helped accelerate the preparation of the 2018 statutory accounts, and we helped ensure they were presented in the best possible light, again to assist with the view on maintainable earnings. We prepared those 3-year detailed financial forecasts to quantify the huge growth potential that Salix had. We got 2 offers for the entire issued share capital, which was the preferred route. There were PE firms that were interested in offering growth capital, but in terms of the shareholders' main objective, which was to take a full exit, 2 really good competitive offers, which we were able to bounce off each other in terms of increase in value. So we increased that initial offer with the preferred bidder by over 12% as a result of that competitive tension. No change to the deal was agreed at heads of terms, despite the EBITDA being short on the forecasts. And as I say, the final price was double what it was probably 18 months previous. And more importantly than anything, in RSK, we probably found the absolute right buyer for our client, and it was a great cultural and strategic fit for them. So that I suppose is my my summary of the transaction. I'm delighted to say we'll be joined by David Holland now. He'll be able to correct me in terms of Salix's business operations. On the slide here, you can actually see David is on the right hand side, shaking hands with Ian Strudwick, who's a environmental director at RSK. And David's in rather good mood at the moment because he's a big Swansea City fan. So they ghosted into the playoffs very recently and then won their first playoff-led game. So David's in very good mood at the moment, I believe.
I've actually had to vacate my little downstairs office to my son's bedroom. You can just about see a Swans football jersey in the background, I think. So I'm hiding away in his room at the moment.
Well, it's always been an exciting few days for you,
Yeah.
David. And so just to tell the audience, probably in a much better way than I just tried to put across, can you tell us a bit about your business? I mean, you set Salix up. Just highlights the audience a little bit about what you guys get involved with, perhaps.
Yeah, you covered it really well, Jack. But yeah, so I set up Salix in 2003, almost as an accident. I had a falling out with a company I was a junior director at, and went home to my wife and 3-month-old baby and said, bad news is I've just quit my job. The good news is I'm setting up my own company. So and that was the start of Salix back in 2003. And yeah, we started off, as Jack mentioned, as a consultancy, providing advice on rivers and river restoration and ways of managing rivers more sustainably for wildlife and to reduce flooding. And then we really got into growing a few plants. We started a little nursery in Wales, and then that grew and grew after the first 18 months of the business. And then the facility we're at wasn't great, so we ended up just by chance bumping into the Raker family, who have got a big farm outside of Thetford, and they put an initial investment into Salix. But more importantly than the cash was the fact we set up this large native wetland and wildflower nursery on their land. And over time, that grew and grew and grew, and then we're getting asked to install it. So we then would be asked to go out and do the planting and do the works on the ground. So we set up a contracting division, which, if we're honest, we struggled with a bit. It's not my background; it's not construction. I'm a geographer and ecologist by sort of background. But so I'd worked with a guy called Pete Barlow, who then came in into Salix business, bought himself in, and he effectively took over the contracting side and grew that. So yeah, we've got 2 sides of the business: the supply of the plants and the products, and then the contracting and the design side on there. And now most of our work is actually turnkey. So most of our work is design and construction. Although we do sell, we have 2,000 clients. We sell plants and sort of wetland and wildflower stuff too. So yeah.
And this won't be a Paxman style interview. This is going to be quite off the cuff, but what made you and your fellow shareholders decide that it was the right time to sell your business?
Yeah, I think it was probably 2017. Pete Barlow, who I won't disclose his age, but he was starting to think about retirement and potentially an exit. And we sort of met and chatted a few times informally about what we wanted to do with the business. And Pete was keen, so it was sort of within 3 to 5 years to, if not retire, but to certainly reduce hours, reduce days, and see that there was an exit potential. So that was the trigger, really. The Rakers and myself, we looked at options, maybe to buy Pete out, continue to run the business. But as time went on, we felt, the more natural, probably the best option for all of us was to look for a sale.
Yeah, and did you put any plans in place before selling the business?
Yeah, so we obviously we thought about it, talked about it, looked a little bit at the market and what we felt the market was going to do. There's some environmental legislation that we felt was driving potential growth in the future. A European directive called the Water Framework Directive that was sort of growing the need to manage our rivers more sustainably. So we did look at that and think, right, there's growth there, but we need to put a plan in place. And that's when we went out and met with a couple of corporate finance companies, and we were very impressed with Larking Gowen, and I'm really glad that we did make that decision. So yeah, it was Larking Gowen who helped us put a plan in place then over a 12-month period, just to, and it's quite interesting. It made us look. Often when you're in a business and you're running a business, you're so focused on the day-to-day nitty-gritty that you don't really sort of stand back and look at the business, look at the market, look at what's happening out there. So I think after the whole preparation process and the whole process of selling the business, we've got to know the market and the business far better than I ever did, and that was quite a surprise to me.
Yeah, and I'm sure that many people that are thinking about selling their business have concerns about it. What was nagging at the back of your mind when you were thinking about selling the business?
I think the biggest concern for us really was staff and how they would react. So we didn't want staff and clients potentially finding out. So we actually kept it from all our staff in particular. That was our main concern. I think achieving a fair price also was always something that we were. So I think when you go into this as a sale of a business process, you need to go in committed. You need to be, I think you need to follow it through and be absolutely certain that you are going ahead with it. So once we made that decision that this is the right thing, I think probably the staff was the biggest, and finding someone that we could work with going forward in the future to help grow the business and help us manage the business, but also some organization that could help our staff thrive as well.
Yeah, of course. I mean, staff is a big thing for everyone, and trying to keep things confidential. It can be challenging. There's a lot of correspondence that goes on throughout a sales process. What surprised you most about the sales process, David?
I'm referring to my notes. I'm super organized. I think the number of potential buyers on the buyers list. There was companies on there that we just hadn't even thought about as potential acquirers of the business. That was a bit of a surprise. Due diligence. I don't think we were prepared for having a part-time job on top of a full-time job. Due diligence was, even though we'd prepared a lot, in that sort of 12-month lead in, that was still a slog. Obviously, because we didn't tell staff and engage with staff, it was down to effectively the 3 shareholding directors to do all the due diligence work. I suppose there's pros and cons of involving maybe senior staff if you need help with that, but we made the decision that we weren't going to do that. So that was quite a surprise. And I think also as well, looking at the market, and we when you start to stand back from your business and look at what's happening in the market, what's driving growth in your market, it was quite surprising that we thought, well, crikey, there's some legislation coming in, and there's some on the European and UK level, which this market's going to explode. So that wasn't really on our radar. We were sort of busy chugging along, growing, but without that awareness that the market was about to go to take off, really.
So would you say that was the most challenging part of the sales process then, that due diligence process? Because it is quite intrusive, isn't it? And, you know, they ask for an awful lot of data.
It is. Yeah, it is. And I think you know, going to meet potential buyers was very exciting, and I really enjoyed that part of it. You know, it was a bit of pressure, but I think it was, you know, it gave you an opportunity to show a bit of pride in what you've grown and what you've developed. But then when you get into the nitty gritty of the due diligence, I think that sort of counters the excitement of all those London meetings. And it is a slog, but it's something that you should be prepared for, and you will get through it.
Yeah, well, it's down to those great presentations you were doing, David. That certainly held with those buyer meetings, that's for sure. You know,
That
if we had
helps,
more,
helps having a drone.
if we had more time today, I'd love to have shown some of those videos, because the site's really impressive, and some of the projects you guys have been involved with are really, really impressive. So I'd urge people, if you're interested in having a look at some of the videos that Salix have produced on their website, please do check them out, because some of the restoration projects, they're quite something to behold. You know, I quite simply looked at that video where the straight river went into a quite windy river, but you saw the impact it had on all the wildlife, and it was incredible. So
yeah,
looking back, where do you think, and I'm going to say your advisors because it was us, where do you think we added the most value from your perspective, David, as a seller? Where do you think we earned our corn?
I think a few things. I think, yes, the final deal and the negotiation, but if you take it back a step, I think helping us at that sort of almost business health check and getting the business over a 12-month period in a far better, stronger position to sell. I think that was very, very important. So yeah, Larking Gowen were great. They helped us, you know, with that process. And then obviously, yeah, you know, putting together the buyers list and the contacts. You know, as I say, there were companies on there that we hadn't even considered as potential acquirers. And I think then from that process, setting up the meetings and controlling the meetings with the potential buyers, I think that was a real asset that we could go in, and those meetings were very controlled, very relaxed, but very controlled. And you know, we didn't, Larking Gowen didn't let it drift in different directions. It was very focused, and I think that was really good. And then obviously, as Jack highlighted, I think, you know, one of the things we wanted was a fair price for the business. You know, our aspirations were, as long as it's fair, we're happy to, and it's the right company for us and culture. You know, we'd go for it. And yeah, I think, you know, being able to have a bit of friction between potential buyers and, you know, obtain the best price for the business was really impressive.
And how are you finding life under new ownership, going from owner manager to employee? I mean, has it been a good move, and how have you found that transition?
Yeah, I was quite lucky that obviously we had 2 meetings and a couple of phone calls with Ian Strudwick, who's now my boss effectively. Salix sit within his division of RSK, and you know, we hit it off straight away. He's, you know, a genuine good guy, and I think that was quite nice in the culture within RSK. Is that I'm a geographer, and the guy who started at Alan Ryder was a geographer. Ian's a biologist, so we're all kind of in the environmental backgrounds, quite passionate about the environment. So yeah, and it's been good. Obviously, we would just I think we completed, was it the 6th of February, Jack, this year?
Yeah,
around that time.
Yeah, it was very early February. It's quite rare to get those old school completion meetings, David, where everyone gets together and it's out for a few drinks, which again, I think is a sign of the cultural fit you had with the buyers. It was nice that they all wanted to come down, because they're primarily based in the Northwest, aren't they? So, you know, a lot of people travel down to London to make a real celebration of the deal completing. As I say, a lot of the time now, once you've been through that due diligence process, which is a bit of a drag, you can see sort of remote completions where 2 sets of solicitors that have probably grown to hate each other just complete, you know, remotely. So it was nice to celebrate in that way. I mean, I think that's all from me in terms of questions. I know that James is lurking in the background, and he's probably got some killer questions lined up that he'd like to pan in, but I didn't have anything further. James, did you have anything else that you wanted to add at this stage, or pick up on any questions that have come in?
Well, firstly, thanks very much, David, for coming on today. That's really useful to have your insight. You've been through this, and many of the people that have tuned in today you know, maybe contemplating stepping into your shoes going forward. So sort of getting your first-hand experience has been really valuable. Thank you. I mean, I've got lots of questions I could ask, but I'm conscious that we're aiming for sort of a wrap up within the hour. There have been a couple of questions that have just popped through on the question bank, and if anyone else has got any, then please do raise them now. I think the first one is in relation to the sort of emotional impact of the sale, David, and you know, your story there about starting the business back in 2003, you know, fortune favors the bold. You a young child, you've started a business on your own. This has been, you know, almost your other baby there to look after all those years. You've gone through quite a lengthy sale process, as they tend to be. Lots of due diligence questions to handle, lots of meetings, everything else. Well, how did you handle that sort of that impact of suddenly, as Jack said, sort of turning from, you know, sort of owner to employee effectively, and sort of, you know, cashing in your chips, and how did you find that?
Yeah, everyone listening today will know, you know, that if they're running their own businesses, the amazing amount of commitment you put into starting a business and running it, and the highs and lows you get, the buzz, and the periods where, you know, you can't face going in on a Monday. So it is a roller coaster. So you do get emotionally attached, I suppose, to a business. But I think that was, you know, what we had a couple of years talking about it. I think the three of us as shareholding directors, and that helped. And when it came to it, you know, I'm still the managing director of the business. I'm still tied in relatively long term. I'm still the face of Salix, I guess. So yeah, maybe that softened it a bit, but I didn't feel particularly emotional about it. At the end of the day, it's a business, and my biggest concern was for staff and how they would react to it, and how they would take the news, and how they would integrate.
And that links into another question on here, which was very much about sort of how you supported the staff. And I think this probably comes back to, like, you know, take us through, you know, the announcement and the reaction of the staff, and how you handle that sort of integration period in those first few days.
I think one or two staff had a slight inkling something was up, because we kept asking them for contracts and information that we couldn't find on the server for the due diligence process. But so yeah, we completed, I think it was a Tuesday, and that afternoon we rang, immediately after completion, we rang 2 or 3 senior managers to let them know the news. And I think the fact that we found a really good trade buyer with a really nice culture, a nice people, I think was something that we needed to get over to our staff quickly after completion. So Ian Strudwick and I did a bit of a road trip around the 3 or 4 offices, and we went and met. Within 2 weeks, we'd met all the staff. Ian had given a presentation about the culture and about the background of RSK and how Salix fitted into their plans. So I think getting out and sitting down face to face and being really open with staff and giving the opportunity to ask questions and just be very open about it all.
Thank you. That's fantastic. And a question from me, David, just to sort of kind of wrap up, I suppose. I've got a question for Richard if he wants to come on board in a moment as well. But in terms of, you know, we've got people watching this today who are considering a sale. If, you know, what would you be your standout message? I noticed one of the points you made was around commitment to the process and how important that was. Is that one of the overriding sort of, you know, bits of advice that you would share with people?
Yeah, I think so. I think from our point of view, it was a case of, you know, we agreed that now, we agreed that selling the business was the right thing to do. The next thing then was timing. We wanted that 12 months to get the process, you know, to get the company in shape. And then from that point, then really it was right, you know, we're flicking the switch and we are committed to this. And I think being committed to it, going in half-hearted or, you know, thinking about it then pulling out, I think would have been wrong for us. I think going in, you know, and being fully committed to the process is really important. I think buyers pick up on that as well. If you weren't committed, I think they'd know.
Because there's a huge commitment from the buy side as well, isn't there? So they want to feel comfortable that you'll take it through. That's fantastic. And just a quick question for you, Richard. Just picking up on some of the media speculation. People may not have spotted it, but there has been a suggestion, I think Rishi Sunak has instigated a review of capital gains tax. I don't know how long that might take and what the results of that might be, but your gut instinct on that, I mean, no one's got a crystal ball, but how do you see that panning out?
Oh, I think that's a very relevant question, James. You're right. The Chancellor has announced a formal review of capital gains tax, a call to evidence to start with. The deadline's the 8th of August, and we'll be submitting our thoughts on that, and then a more detailed technical request, which I think closes in September. So the indications are that there might well be some changes announced in the autumn budget. We don't know when that will be, but assuming that will be November, then that kind of ties in. But you're right, nobody knows what the outcome of that review would be. There is a feeling that it is an opportunity to perhaps raise revenue, although capital gains tax isn't a huge revenue raiser when you compare it with national insurance, VAT and income tax. But yeah, entrepreneurs relief, now business asset disposal relief at $1 million. Will that survive this review? Question mark. The flat rate, 20%. Will that be tied to the higher rate of income tax or the marginal rate of income tax? It was at one point a few years ago. Or will it simply be increased maybe to 28%, which is the rate for residential property gains? So we don't know, but it's unlikely to be good news.
I'm going to say it doesn't sound as though the rate's going to be going down for capital gains tax, but the support packages that the government are announcing for COVID-19 are going to be paid one way or the other in the future, haven't they? So we'll watch that space, and I'm sure there'll be lots of announcements from you and your tax team in the coming weeks and months. So excellent. Well, I think we're there. It leads me really going forward just to remind you that all three of these webinars are recorded. They're on our be on our website for you to look back on if there's any points that you want to go over again. You're very welcome to contact Jack, Richard, or me with any queries you may have. And I'd just like to finish by thanking David again for joining us today and sharing his experiences. It's added a fantastic dimension to the message we're trying to get across. So thank you, David.
Absolute pleasure.
David.
Thanks, guys.
Excellent. Well, we've finished on the hour, so I guess I wish you all a good end to your day. Thank you for tuning in, and we look forward to helping you in the future. Thank you.